Amgad Attia, Director of FXDD. Okay, so Amgad is an industry veteran, please join, and a registered commodity trading advisor with the National Futures Association in the United States, and he has over 20 years of experience in the global financial market. Wow. He is also a regular contributor to major TV news networks in the Middle East, such as CBC News, DMC and CNBC Arabia. Mr. Attia is the longest-setting Middle East director for a leading Forex broker with over 13 years of work experience at the FXDD. So, Amgad, you are going to be talking about how to navigate volatility in trading. Over to you.
Okay, so thank you very much for being here. Thank you for the introduction, very kind of you. So today we're going to talk about market volatility. It is a very important subject if you're trading in the FX market and the commodities, and you need to understand the concepts and how to handle a lot of the stuff. Just a quick introduction about who we are as FXDD. We were established in New York City in 2002. We've been there all this time. We're still in 7 World Trade Center. We headquartered in the financial district in New York City. We have a rich history of almost 17 years. I've been with the company personally for 13 years. So we have nice longevity in the market. We're regulated by the FCA. We're regulated in Malta. We're regulated also in Mauritius. So we have multiple international jurisdictions that we work under. We're headquartered at 7 World Trade Center, right in the heart of the financial district. And beautiful place. If you should visit New York one time, you should come and see us. We did a lot of sports sponsorship. We sponsored the Red Bull winning team in from 2010 to 2013 in the Formula One. And we also sponsor Ferrari in the United States. The reason we sponsor sports events is our owner, our ultimate beneficial owner, is also a race driver. So he likes the racing industry. And it's also close to FX. It's always a fast-moving market, like fast-moving cars. So how to navigate market volatility? It is extremely important for you guys to understand that, the financial markets is, volatility by itself is basically the fast and unpredictable price movement that we see on a daily basis in the FX market. It's not just in the FX, in the futures and equities. It's measured in the equity market by the Vix Index. So if you're trading equities globally, you always watch the Vix Index in the US to indicate, it will show you how high the market volatility is. This was taken about 3 days ago or 4 days ago. So the Vix at 16.4. This is usually a high volatility day. Volatility usually goes from low volatility from 8 to 6 to 8, and then it goes up to 24, 26. This is if you're trading in the Dow, in the Nasdaq, but this is like basically the benchmark for measuring volatility in the market in general. So volatility is not just high volatility. Sometimes you have low volatility. If you've been trading for a while, you would notice that during the early parts of 2019, late parts of 2018, we had a very low volatility environment. Basically, market wasn't moving. The range that the market moves on every day was very limited. At certain pairs, we could only move 20, 30 pips per day, which is not really, optimal if you are trading FX. You always want to have things moving slightly faster than this. So the 2008 financial crisis was the climax point of the volatility in most asset classes. If any of you was trading back then, we had huge price fluctuations. We're getting close to this now, especially with the Brexit news, which we'll cover in a little bit. Central bank intervention during the last 10 years have artificially lowered volatility, reduced natural market liquidity provided by normal market participant, and replaced it with cheap government money. So when the financial crisis hit in 2008 and liquidity evaporated, central banks intervened in the US, in Europe, and a lot of other countries, and basically injected artificial liquidity. So cheap money, basically they increased their balance sheet, took all the debt on the central bank in hope of stabilizing the market, which did work for a while, but as with anything that you do, there's always a side effect. There's always a negative effect, if you want to call it that way, which we are actually going through now. So every time central bank, 2008 came and went, things start to stabilize, things start to improve. So central bank is trying to normalize interest rate again. They're trying to normalize the trading environment, basically by bringing interest rate up to a normal rate, which is usually around the 2% mark. But every time we try to do this, the market has a fit. So basically, market became like your spoiled child that you cannot, does not want to be weaned off baby formula, or a child that wants to be carried all the time by their parents and don't want to be put down. So this is how we all turn out, turn out to be for quite some time. If you're following the FX market, if you're following the global market, you will always see, as soon as they hear the central bank saying that we are trying to normalize policies, market crash. You put a lot of pressure on central bankers to basically keep an unreal low interest rate. We've noticed in Europe now, its interest rate is about 1%. United States, Mr. Jerome Powell is under a lot of pressure for President Trump.